Not to put you on the spot, but do you know what a debt to income ratio, or DTI, is? DTI is a qualifying ratio used to make sure that a borrower has a high likelihood of being able to repay a loan. It is calculated by comparing monthly income to monthly debts. At first thought, it seems like DTI is a simple thing to calculate. However, not all debts count and not all income counts. That is where things can get tricky. For income to count, it generally needs to have occurred steadily or be increasing for 2 years and be assumed to continue for at least 3 years into the future. Any income that has not occurred for 2 years, such as overtime, bonuses, commissions, etc., most likely will not be able to account unless it is contractually guaranteed and spelled out somewhere to that effect. If income is declining, that can also be problematic for qualifying. In regard to debt, there are many different types of debt that could factor into the monthly debt to income ratio for mortgage qualifying. Most debts will show up on the mortgage credit report the lender runs for your pre-approval. Some examples of these debts that show on a mortgage credit report are mortgages, vehicle loans, recreational vehicle loans, student loans, credit cards, and personal loans, to name a few. It is not the total balance owed that determines the debt to income ratio. Rather, it is the monthly minimum payment on that debt that goes into the ratio. So if a credit card balance is $3,500, but the minimum monthly payment is $35, the $35 is what goes into the debt to income calculation. Collections accounts can also come into play depending on the total balance owed. There are also some debts that do not show on the credit report but factor into the debt to income ratio, such as buy now, pay later accounts, child support payments, and alimony payments. Additionally, not all monthly recurring payments are included in the DTI calculation. For example, childcare and monthly utilities do not count towards the debt to income, even though they are a very real cost for most of us. The amount of the minimum monthly payment for student loans can also vary by loan type. Some loan programs use 1% and others use 0.5%. Sometimes qualifying can come down to these nuances. Your loan originator or officer can help you figure out your current debt to income ratio. Your debt to income ratio can make you ineligible for certain loan types. Sometimes it makes more sense to pay something off to qualify for a different loan type rather than putting more money down on your home purchase. What does a low debt to income ratio and high debt to income ratio signify to a lender? A low debt to income ratio means a borrower has lots of positive cash flow compared to their income. A high debt to income ratio can indicate that a borrower is overextended and may have trouble making payments in the future. What housing costs factor into DTI for the front-end debt ratio? Those costs are principal, interest, taxes, hazard insurance, HOA dues, condo association fees, and flood insurance if applicable. There are also limits to the housing debt to income ratio for some loans, and for all loans there is an overall max debt to income ratio. These are referred to as front-end and back-end DTI respectively. What are the DTI maximums? They vary by loan program, credit score, and down payment amount. Front-end housing ratios range from 29% to 50%, and back-end total debt ratios range from 43% to 55%, which can be a significant difference in qualifying and make the difference between being able to buy a home or not. As you can tell, a seemingly simple metric is pretty complicated under the surface. I hope this helps shine some light on the debt to income topic for you. If you have any follow-up questions to any of the information presented, please let us know.